Yeah, we're going to explore the thinking behind Chris Camillo's Laughing at Wall Street and, layer on some perspectives from behavioral finance, too.
And practical trading stuff. The goal here is really getting the essential wisdom, stuff you can use to navigate the market maybe a bit more effectively.
Exactly. We've looked at Camillo's book, used summaries from Bookie and Reddit, plus an Investopedia piece on behavioral finance, and a YouTube interview with Camillo.
So quite a mix of sources.
Right. And the aim is to give you, our listener, actionable knowledge, help you become more informed, maybe even a bit more unconventional in your strategy.
Okay, let's unpack the central idea then. Camilla's whole approach, it seems to hinge on this concept of information imbalance.
Mm-hmm.
It goes back to advice from his father, apparently. The very best time to buy a company's stock is when you think you know something about that company that others don't.
It sounds simple, almost too simple, doesn't it?
Yeah, but it really flips the traditional Wall Street script on its head.
It really does, especially when you think about the efficient markets theory. The idea that it's super hard to beat the market because all the public info is already baked into the price.
Right. Camillo just flat out challenges that. He believes you can find valuable information that isn't fully priced in yet. Pockets of it.
He calls it game-changing information, looking for those unique insights, those trends starting up before Wall Street notices.
Yeah. And his examples are pretty compelling. Like, take his Peloton trade during the pandemic. He noticed they'd stopped advertising.
Which sounds bad on the surface.
Exactly.
Mm.
But he realized it was because demand was just so overwhelming they didn't need to advertise.
Yeah.
The market, though, was maybe still stuck on their old ad spend numbers. Missed the signal.
It's fascinating using a seemingly negative thing, no ads, to spot this massive positive shift. The market was anchored, right? Anchored to the old story. And it's like the Nintendo Wii example, too. The market was obsessed with PlayStation versus Xbox, the specs war.
The traditional console battle.
Yeah. They totally underestimated the Wii's broader appeal, the whole motion control thing. Camillo saw that broader market potential.
So it really makes you question those traditional analysis methods, doesn't it? Technical analysis, fundamental analysis.
It's definitely skeptical. With technical analysis looking at chart patterns, his point is, once a pattern gets known, the market corrects for it. It kind of disappears.
So the predictability is an illusion, maybe?
That seems to be his take. And then fundamental analysis, looking at a company's intrinsic value. Well, he acknowledges it's important.
Yep.
But the market can take ages to recognize that true value. You might be right, fundamentally, but the stock just sits there for years. It's a timing problem.
Right, and he even questions mixing them. He points to evidence suggesting portfolios that blend technical and fundamental don't actually do better than ones using neither.
Which is pretty provocative. It makes you wonder about all the complex models out there.
Yeah, and it leads to his skepticism about Wall Street expertise in general. The fact that so many professional fund managers, despite all their resources, don't consistently beat the market.
It's a well-documented thing. It does make you ask, is all that complexity sometimes just noise, maybe even a disadvantage?
So he's not relying solely on charts and financial statements. Where does he get his ideas?
Well, this is where it gets really interesting. His main source of alpha, that market-beating edge, he says it comes from everyday life.
Just observing.
Pretty much. Observing social trends, listening to what people are talking about. He literally says people conversations, just observing the world's conversations.
Wow. Okay. So how does that work in practice? Does he just eavesdrop a lot?
Well, maybe a bit. But it's more about distinguishing that social data from hard data, like Google Trends. He uses Google Trends too, but sees it as more direct, less interpretive.
Okay.
Social conversations, though, that's where you can spot the nuances, the shifts in how people feel about a brand, an anomaly. That's where the edge might be.
So you have to interpret it more.
Exactly. He encourages people to be like private investigators. Stay curious, engage with culture, movies, social media, what your friends are talking about.
Looking for clues?
Yeah. He gave an example of noticing shoppers acting unusually at Coach stores. That sparked an idea. It's about connecting those real-world dots.
So your own experience as a consumer could actually be valuable data. If you see everyone suddenly using a new app or talking about a specific show.
That could be an early signal, potentially before it shows up in the quarterly reports.
Okay, but we need balance here. Investing isn't just about spotting trends. There's the whole psychological minefield, right?
Yeah.
Behavioral finance.
Oh, absolutely crucial. And two big biases Camillo's approach seems relevant to are loss aversion and familiarity bias.
Lots of aversion. That's the classic losing hurts more than winning feels good thing.
Precisely. We feel the pain of a loss maybe twice as much as the pleasure of an equal gain, and this leads to the disposition effect. Selling your winners too early because you want to lock in the game, but holding on to losers way too long hoping they'll just recover. It's emotional, not rational.
Yeah, I can see that. And familiarity bias.
That's just sticking to what you know.
Yeah.
Investing in companies in your own country or maybe your local area just because they feel familiar and safe.
Even if better opportunities are elsewhere, you miss out on diversification.
Totally. And being aware of these biases, loss aversion, familiarity, overconfidence, all of them is just so important for any investor. Recognizing them in yourself is the first step.
Makes sense. Okay, so let's get practical.
Yeah.
He finds ideas through observation. He's aware of biases. But how does he actually trade? Does he just jump in?
No, he definitely emphasizes due diligence. You still have to research the business, understand what you're investing in. The observation is the spark, not the whole fire.
Got it.
And he talks about categorizing trades by how strongly he believes in them. Conviction level.
Okay, how's that work?
So, a low conviction idea, maybe something interesting but not fully fleshed out, might only get a couple of % of his portfolio. Small bet.
Right.
But a high conviction trade, where he really thinks he's found that information imbalance, he's willing to put a significant chunk in, maybe 20, even 30% into one stock.
Wow, that's concentrated.
Yeah, he mentioned Wii and Peloton as examples of those high conviction plays. Takes guts, but it comes from that belief in his unique insight.
But he does draw a line, right, between money you can afford to lose and essential money.
Oh, absolutely. He calls it risk money. That's separate from money needed for, education, bills, your core security. That distinction is vital.
What about more complex stuff like options?
He does use options, yeah. Typically looking for a longer expiration date, so giving the idea time to play out, and often in-the-money strikes.
Which means they already have some value baked in?
Correct. But, and this is critical, he stresses, and we need to stress, options are much riskier. You can lose your entire investment very quickly. It's not for everyone.
Good point. He also mentioned something about being aware of other things happening beyond your initial reason for the trade.
Yeah, that's key risk management. Your initial insight might be great, but what if there's a sudden lawsuit, or new regulations, or a CEO leaves, or a big investor dumps their shares?
Stuff that can blow up your whole thesis, even if you were right about the initial trend.
Exactly. You need to be aware of the whole picture, the whole context of your trade's time frame.
Okay. Now, what's this other people's money or OPM concept he talks about?
It ties into that risk money idea. Taking calculated risks, maybe with funds that weren't part of your core savings plan, windfalls, bonuses, that sort of thing.
Why does that make a difference?
Psychologically, it can feel different. There's maybe less emotional attachment, which might make it slightly easier to put towards those higher risk, higher potential reward plays, like options.
Interesting. But he balances this risk-taking side, doesn't he, with something safer?
Yes, absolutely. He talks about having a lockbox, a completely separate fund dedicated to long-term financial security. This is your safe, risk-averse money.
Contrasting with the big money account for the riskier investments.
Exactly. And for that lockbox, he's a big proponent of low-fee investing. Think index funds, ETFs, just steady, cost-effective, long-term growth. Build that foundation first.
Okay, so bringing it all together, what are the really core takeaways from Laughing at Wall Street, the main principles?
Well, a few really jump out. First, this idea that nobody knows anything for sure in the market. Humility is key.
Right, no guarantees.
Second, that traditional financial expertise doesn't automatically mean success. Don't be intimidated by Wall Street complexity.
Simplicity can win.
He seems to think so. Simplicity can be truer. Also, uncovering that game-changing information before everyone else is crucial. That's the hunt.
Invest in what you know, or what you can really understand through observation.
Yeah, and even paying attention to emotional connections people have with products that can signal real consumer interest, real traction.
It's quite an empowering perspective, actually. It encourages you to trust your own eyes and ears a bit more.
It really does. The message is sort of, combine your own observations, understand the market isn't always perfectly efficient, be aware of your own psychology.
And you might just spot opportunities others are missing.
Potentially, yes, but always with that due diligence and risk management layered on top.
So the challenge for our listeners maybe is to start looking around differently. Think about the trends you see, the conversations you hear.
Exactly. Are there any hidden gems, any information imbalances hiding in plain sight right now? How could you apply some of this thinking?
Food for thought.
Definitely. And if this resonates, we'd really recommend diving deeper. Pick up Laughing at Wall Street, maybe read up on behavioral finance. It can genuinely change how you view investing.